So, good morning, students. We have got good news for you. Mr. Borman has actually just mentioned that. Instead of only having four class tests, four class tests and an assignment, so in other words, five class assessments, we now have six. So we're going to have an additional class test. Now, why that is good news, ladies and gents, that gives you a further opportunity to do well. So you can increase, you can boost your year mark, your uh, Kosa, I think maybe Mrs. Moore can tell me. Can you hear me,
Yes, I can, Mr. Van Rensburg.
Kosa? Then I think it's just your audio device that isn't correctly. Thank you, Petunia. So it's just your audio device that isn't correctly on the correct settings. So just go to settings, that little cog, and then you go to your audio device. If you are, it's depends what you are using. If you are using earphones, for instance, and your audio device indicates speakers, then you won't hear me. Or if you are using speakers and your audio device is set for earphones, then also you won't hear me. So it has to be set to the correct device that you are using for listening. Okay, so at least you can hear me. Right, so you've got an additional opportunity. So there are now six class assessments, five class tests, plus that assignment that we had in the first semester. So then we are going to take the four best marks out of six. So instead of taking four best out of five, you now have the opportunity to do two additional tests. One, if I'm correct, Mr. Borman, one will be on the topic that we are starting today, inventory and foreign exchange, and the other one on our final topic, which is the statement of cash flows. Okay, ladies and gents, I don't know if Mr. Borman wants to add anything there or Mrs. Moore.
You've said it all, Mr. Van Rensburg, so I'm good with that.
I
Okay.
just want to mention that it's very important that you work very hard in the next 2 weeks, because next Thursday night we have our class test on foreign exchange transactions. Oh, sorry, for the full-time students, it's 2 o'clock Thursday afternoon.
Yes, so that is just around the corner, ladies and gents. So we've got to work really hard on this topic in the next 10 or 11 days, right? So the topic that we are starting today is, we call that inventory and foreign exchange. Now it's for me a very exciting topic, and I hope you find it exciting too, because not only are you going to learn a few tricks about inventory, not only are you going to be learning about how to deal with foreign currencies and foreign exchange, it also teaches you a little bit about economics, the world's economies. It teaches you a little bit about how the world actually works, how it operates, how trade happens and occurs between various nations and various domains. So, I find it a very, very exciting topic, and like I say, I hope you will as well. Now, ladies and gents, just to get the ball rolling here, I'm going to ask you a few questions, and you are welcome to answer it in person, or you can type it in the chat facility. When it comes to foreign exchange, there are many aspects to it. For instance, if you have a branch in a foreign company and you have to incorporate their results or their assets and liabilities, the financial position into your company statements, obviously, then you'll have to convert or translate it into your local currency. There's also the matter of foreign creditors and foreign debtors. So we are just going to start with one aspect of foreign exchange and inventory, and that is where we are the importers of inventory. So we are importing inventory from a foreign supplier, right? So that makes us the customer. So we will have to get these terms very clear in our heads today. So we are the customer and we have a foreign supplier. Now, why is that important to understand, ladies and gentlemen? Perhaps I should also mention you will also find a few auditing terms in this topic. Why is that important? If you think now to internal auditing 2, which you are already 3/4 of the way through as well, let's say you as a customer, you purchase inventory from your local supplier, right? And you go and fetch it at their warehouse. So you take your truck, you as a customer, you go and fetch it at their warehouse. So you are going to sign a document there that places the custody in your hands. So when do you become the legal owner? When do you get the risks and benefits of being the owner of the inventory? When you order the goods, when you go and fetch it, or when you actually bring the goods back to your premises, when the goods arrive back at your premises, when do you take on board the risk for protecting that inventory? If you can type for me there, please. When you fetch it, when you order it, or when you deliver it to your premises. Thank you, Corsair, and I hope you can hear me now. I see you've logged in a second time. Absolutely correct. When you fetch it, because the reason that you are signing a document there is you are taking custody. So it is now your responsibility, right? So if you crash your truck on the way to your premises, it's not the supplier's problem anymore. It's your damage now. You understand? Perfect, perfect. A1. Thank you, Corsa. Now, let's say, for instance, you order goods from from your supplier, and you arrange with the supplier that their delivery people will deliver the goods to your premises, right? So what they will do, they have a dispatch department there, as you know from internal auditing too. The dispatch department will pack the goods, they will transport the goods, they will send a document. They will send a specific document that accompanies the goods to your premises. If you can type for me there, what do we call that document? Thank you, Gordon. You're the only one awake. I see we're almost up to 60. That's good. What about the others? Are you still having your morning coffee? A delivery note, exactly. It's a delivery note. So you take the original of the delivery note, as well as how many copies do you take to the customer if you are now the supplier? The original copy, which the customer can keep. Two, there we go, and also a copy thereof. Why do you take, as a supplier, a copy? For the customer to sign that copy, and that copy is going to come back to your warehouse. That is your evidence that you have delivered the goods. So you, as a supplier, then is no longer responsible for the well-being or the care or the custody of the goods. It's now the responsibility of the customer, right? So clearly, ladies and gents, if that delivery van crashes and the goods get damaged, it is not the customer that is going to bear the responsibility for the damages. It is still the supplier. Now, to cut a long story short, when it comes to foreign trade, we have a strange little situation where at some period in time the inventory is not under the control of the supplier, and neither is it under the control of the customer yet. So we have to determine, and this is where all sorts of negotiations come in, we have to determine at which point in time does the risks and benefits of ownership for that inventory transfer from the supplier to the customer. If heaven forbid, I don't want let's touch wood. I don't want to bring bad luck to the world. But let's say, for instance, that the inventory is going to be transported by aircraft from London to Cape Town, and that airplane disappears over the Atlantic Ocean or somewhere over the African jungles. We have to understand who is going to carry the damages, who is responsible for the goods at that point in time. Because once the goods are on that aircraft, it's not under the control of the supplier anymore, and it is not under the control of the customer yet, right? So there's got to be negotiations. Who's going to pay for the freight charges? Who's going to insure the goods against damages? Then we get even more extreme situations, when it comes to local trading. If you order something at 9 o'clock this morning, you can probably go and fetch it within an hour or so, and within 2 hours, it's at your premises. Or even if you order goods from let's say Johannesburg or Durban, it can still reach you by plane within 4 or 5 or 6 hours, right? The flight is only 2 hours, but I mean just to get everything packaged and ready and loaded and so forth, right? But very often you get situations where the goods are extremely heavy, right? Um, as a matter of interest, when it comes to freight on an aircraft, what is the determinant? What determines the price that you are going to be paying for it to be transported by aircraft? It is not the space that it takes, it is the weight. Because you remember mass, thank you, Corsa, you are really sharp this morning. The mass or the weight of it, right? The heavier it is, the more fuel the plane will use. Uh, in other words, it's going to cost you more, right? Whereas on a ship, ladies and gentlemen, it is not the weight that determines your freight charges, it is actually the space that it takes. Because in those on those enormous rigs, those huge freight boats, you can load thousands of tons of items. So it's not the weight that determines it is how much space it takes. But certain things simply cannot be transported by plane. Um, if you think about those huge mining vehicles, we did property, plant, and equipment recently. Those huge mining vehicles and quarrying vehicles, they weigh probably about 40 or 50 tons, right? Now I know that they assemble it in South Africa, but the parts still need to be transported, let's say, from the United States, right? So the parts, before they can assemble it, must be transported. So it's going to be absolutely ludicrous to try and transport that by plane, right? It's going to cost you millions, many more millions than what is warranted. So you're probably going to transport that rather by ship. Now that takes a while, ladies and gentlemen. If you're going to transport it by ship, let's say from New York Harbor to Cape Town Harbor, it's going to take a while. It's going to take a week or two. And sometimes you find that the weather at sea is a little bit stormy, and they have to find a refuge in another port for a few days until the storm is over. We recently had those hurricanes over the North Atlantic, which did quite a lot of damage to the United States East Coast. So we know that happens, and it happens actually quite regularly. So, ladies and gents, so you can imagine during that voyage, anything can happen. The ship can tip over. Like I say, touch wood. I don't want to hex anything, and all the inventory could be lost. So, who's going to pay for the insurance? Who is responsible? So, we have to have certain rules of international trade, whereby which we determine that. Now, I'd just like you to look at a little slideshow that I want to show you, just to illustrate what we've been saying. If I can just find that. I think it's that one. Right, so there's a typical container in which goods will be exported by the supplier, and which goods will be imported by the customer. Now, the interesting thing about that is very often those containers actually belong to individuals, investors, and they get rented by the shipping companies. But that's not important. So what actually happens is the foreign supplier, once the customer has ordered goods, the foreign supplier will then package the goods and then load it into one of those containers. So those containers are actually pretty huge. I'm not exactly sure what the dimensions are, but I think the height is about 12 feet. So A person standing next to it would that person's head would only be about halfway up that container if that person is 6 feet. Now, you probably don't know what 6 feet is. Let me think. So that's about 1.8 meters. So in total, this should be about I would guess just under 4 meters, about 3.5 meters high. And as you can see, it is pretty long. Let me just confirm that you can actually see this. Yes, okay. So let me go to the next slide. Let me just go down. So what we can see here, this is a shipping container. It is ready to be loaded by the foreign supplier. At that point in time, it is still under the control of the foreign supplier, right? So the foreign supplier still has control. So the foreign supplier will then either transport it themselves or arrange for transport to the harbor, and then once it is loaded onto the ship, it is clearly not under the control of the supplier anymore. Now it is under the control of the shipping company, right? And it is obviously because it hasn't reached its port of destination yet, it is not under the control of the customer either. So now it's under the control of the shipping company. So we will have to determine when are we going to be regarding the transaction date to have taken place. But anyway, let's just go through this. So the next step is that those goods will be loaded on board a ship that is going to be let's call this our port of origin, the port of origin, the port that is in the supplier's country. So as you can see, those rigs are enormous because those containers themselves are big, and there are a lot of them on that ship, right? So we see the cranes there. If you've ever driven past Cape Town Harbour, or if you've been at the V&A waterfront, then you would have seen in the harbor those enormous cranes, right? So then, ladies and gents, after that, the harbor master will arrange for a tugboat, somebody that knows the harbor. Obviously, that huge ship is too large to maneuver within a harbor on its own. So the tugboat will come, and those tugboats, even though they are relatively small compared to the big ship, they've got pretty strong engines, right? So the tugboat will now pull that big ship with all its containers out of the harbor, and then it'll sail, right? It'll sail on the ocean for a few weeks. Like we said, if there's a storm, they might have to find some protection or refuge in a harbor for a while, and eventually it will reach the port of destination. Right. That I'm using the same. Let's now imagine that this is our destination. Turn. As soon as their turn comes, the harbor master will send out a tugboat or two, and then they will pull the big ship into the harbor until it is properly docked. Right. So now we've got a further stage. The ship has actually reached its destination port, but the goods have not been loaded off from the ship yet. Right. So it is still under control of the shipping company, Maersk Sealand in this particular photo. Right. So it's not under the control of the customer yet. It's been a few weeks since it's been under the control of the supplier. So, but at least it's now in the port of destination where the customer resides, right? I know I'm reusing that same photo, but imagine you are now in the port of destination. Now the goods are loaded with those massive cranes off from the ship. Normally, they don't go straight to or they will never go straight to the customer. They must still go to customs, right? The customs people, the customs officials must first clear them. So the customs officials will first of all make sure that there are no contraband, that there's no illegal drugs that's being imported, or there's no dangerous weapons being imported, that kind of thing. And then, as usual, they slap a tax on it, right? Which we call import duties. Right, and then eventually, when it has been cleared by customs, then the customer can arrange for a transport company that can now pick up that huge container, or the huge container will be lifted by the crane from the ship, and it will be deposited on the, what do they call that open back? I think they call it, what do they call it? Some kind of animal name, I forget now. But anyway, so they'll deposit it on the back of that truck, and they'll secure it, and the truck will then drive it over to our premises. Okay, so that is just an illustration there. So, ladies and gents, clearly we see that we have this situation where, where the transaction date, which is when the customer becomes responsible for the goods, can happen at various stages, right? So I'm just going to open a blank Word document that I use as a whiteboard here. If I can just do that quickly. So the first thing that we can write for us here, one of the problems, if I can call it a problem, or one of the issues that we have to determine when it comes to foreign exchange transactions, is actually the transaction date. When are we going to deem the transaction to have taken place, right? The transaction date, maybe I'll I'll put a question mark there, the transaction date. So, ladies and gents, we're going to talk about the various ways in which the transaction date can be determined in a little while, but let's just focus on which dates are important for us, right? So we've got to determine when we as customers have become responsible, when the risks of ownership have transferred to us, and also then the benefits. Now we can do with it what we want, right? At which date. Another important date for us, ladies and gentlemen, when it comes to foreign exchange, is our settlement date. Settlement date, right? You don't have to put a question mark there. That will normally be straightforward. So settlement date is simply the date on which you make payment. You as a customer and importer, when you as a customer and importer, when you make a payment to that foreign supplier, right? Either a payment in full, if we say that the account has been settled, it means you have paid that account in full. Or if they say you've paid a certain amount on that transaction or on your account, it means you haven't settled it in full, but you've still made a payment on that particular transaction or on your account with that supplier in general. Then, ladies and gentlemen, we've got another little date here that is very important for us, and that is if there is a financial year end between the deemed transaction date and the settlement date, that date also becomes important. So I'm going to put that in between those two, so transaction date, and if there is, let's call it a reporting date. Because when you've got a financial year end, you've got to draw up your financial statements. We call that your reporting date. Now, obviously, we don't need to put a question mark there. That we know. That comes from our memorandum of incorporation. What is our financial year end? Now, ladies and gents, I'm going to ask you a few questions here that you can please type for me again, or you can say it in person if you wish. Let me just go to the chat facility. Let's assume that we've purchased goods on credit from a foreign supplier, right? And we've got a reporting date. That means we still have a balance on our foreign creditors account, right? The foreign creditors control account in our general ledger and our foreign creditors subsidiary ledger, right? So that's an outstanding balance. Now, let's make this practical. Let's assume that we have imported this from the United States of America, right? We've imported this from the United States of America. Now, when that supplier sends us an invoice, are they going to denominate that invoice in their currency, the dollar, or are they going to denominate it in our currency, the South African rand? If you can just type for me there, rand or dollar. Thank you, Corsair again. Dollar, quite correct. There, thank you, Bonga. Thank you, Audrey. Audrey did reply a little bit earlier. Thank you, Ntukozo, Glory. Okay, everybody's awake now. Okay, fantastic. So you're going to get an invoice in dollar. And at the end of the month, they might send you, and let's assume this month end now corresponds with your reporting date, your year end date. Uh, they're on the ball. So at the end of the month, which is now just happens to be your financial year end, if this amount is still outstanding, do you owe that amount to your foreign suppliers in dollars or do you owe it in rands? Are they going to change the amount that's outstanding on your account? It's still dollars. Thank you, Corsa. It's still dollars. So they're going to send you a monthly statement that is, thank you, Ibonga, that is still denominated, thank you, Petunia, in dollars. Right. Now, if it happens that the exchange rate, and we're going to talk about exchange rate soon, if it happens that the exchange rate since the transaction date up till the reporting date, which can now be perhaps a month or two later, if that exchange rate has fluctuated, do you think that will have any effect on the inventory, the value of the inventory that you have already taken custody of, let's say 45 days ago? Will it have an effect on the value of your inventory? Corsa, you are extremely quick. I don't know what exactly, ladies and gents. Thank you so much. Now, there we've actually addressed one of the first problems that students often have with foreign exchange. Remember, you have already done the purchase. You've become the legal owner of the goods 45 days ago. So the fact that you still owe money at the end of your financial year to your foreign supplier has no effect on the value of the inventory. That has been pegged. That value has been pegged on the date that you deem to be your purchase date, the transaction date, and we'll go and have a look at when we can deem that to be. However, however, ladies and gentlemen, will it have an effect if there had been fluctuations in the exchange rate between the rand and the US dollar? Will that have an effect in rand terms? We've already said it's not going to have an effect in dollar terms, but will it have? You've already answered my question. Thank you. To Kosa, Nelisiwe, thank you. It will have an effect on the rand value. If the value of the rand has weakened against the dollar, it means we'll now have to pay more rands for each dollar. So it means that when we are settling our account with that foreign supplier, which wants to be paid in dollars, it's going to cost us more in rand terms, right? Now we also know from IAS 1, International Accounting Standard 1, that your financial statements must be a fair presentation of what? It must be a fair presentation of the results of your operations. In other words, the performance of the company, the performance, but also the financial position of the company. And as we will remember from IAS 1, all of the cash flows of the company. But now we are looking at the financial position. When it comes to the financial position, it must be a fair presentation. In other words, your foreign creditors must be fairly valued. So, ladies and gentlemen, what this all leads up to is that now you cannot just leave your creditors balance, your foreign creditors balance as it was on the date of the transaction, because the exchange rate has now changed. The rand has actually strengthened quite a bit against all the major currencies over the last 10 days or so, which is a good sign for importers. It's a bad sign for exporters. But anyway, that's a different argument. Right, so if we look at the opposite point of view, like has been happening in the last week or so, the rand has been strengthening against the US dollars. It means each US dollar is going to cost you less in rand terms. So even though you still have to pay that supplier the exact same amount in dollar terms, it's going to cost you less in rand terms. Less rands will flow out of your bank account when you do that electronic funds transfer to your foreign supplier. Right. Okay, ladies and gents. Um, I've only got an hour, so I better speed up a little bit here. What I also want us to go and have a look at is a picture I've got here. Let me just find it. Of a bureau de change. Just find that little picture. Now you can tell me, let me just go back to the chat facility quickly. Now, have any of you actually seen that? Have you ever seen something that is called, it's a French term that basically means money changes, right? Money, they're changing your money. Thank you, Corsair, Audrey, Glody, and Tukozo, Tamia, all of you, thank you. Where have you seen it? If you can perhaps just type for me, where have you actually seen that? Any one of you, or any 3 or 10 of you? At the airport. Thank you, Kosa. Thank you, Shanley. Untukozo again, thank you. At the airport, this picture is actually one that's in the, it's either the arrivals or the departures, international arrivals or international departures lounge at Cape Town International Airport. But you also find the larger branches of banks will have that, right? So the larger branches of banks will also have a separate little area called the Bureau de Change, or Bureau de Change, as they say in French. And there you can actually go and change your money. You can transfer, you can convert your rands into pounds, or your pounds into dollars, or your yens into euros, or whatever the case may be, right? Now, if you have a look at that picture, so I'm glad all of you have seen that, so you realize I'm not talking pie in the sky here. These things really actually exist, right? So at each international airport, at the departures lounge, you will have one. At the arrivals lounge, you will have one. And then the major branches of the banks will also have that, where you can change your one currency into the other. Now, if you look at that third window, the right-hand side one, you'll see there's a blue screen at the back. I haven't got the exact picture of that, but I've got a similar one. That is called a ticker board. There they give you a second-by-second update of what the exchange rate between certain currencies are. So I'm just going to show you a little picture of that as well. So let me just go out of that one. And while you're waiting, if you can just make sure that you've got a calculator handy, please. We're going to do a few calculations now. Let me just go find that picture. Okay, so there we have our ticker board, right? You know, I wouldn't recommend you go and sit there and watch it. You know, it'll be like watching paint dry, or like watching grass grow. So it doesn't move much, and it doesn't move that often. But every few minutes or so, you'll see one of those digits clicks over, right? So that means there's been a fluctuation in the exchange rate for some reason or other. Let me just go back to the chat facility quickly. Just trying to see. Okay, it's still airport. Okay. So there we've got our ticker board. So maybe let's just go and have a look at how that works. So if I go to the ticker board, we see that they say we sell, and then we've got a column for that, and we buy. So that again indicates that you can actually buy a currency. You can buy another kind of money with your kind of money, almost like it is merchandise, right? Or you can sell your particular currency. So let's just go down to the second one from the bottom. By the way, this is this is one that comes from Heathrow Airport in London. So this is British pounds, right? So if we look at the second one from last, we see our South African flag there, and they say we sell South African rands at 16 pounds, 16 rand 61.1 to the pound, and we buy it. We buy South African rand at 19 rands 23.38 rands. Right now, ladies and gentlemen, why there is a difference between their buying price and their selling price? It's a business. It's a business. That is how they make their profit, right? So they are going to buy your rands. In other words, if you want to convert your rands to pounds, you're going to pay more for it. So in this particular case, if you are going to be buying pounds with your rands, you're going to be paying 19 rands, 23.38 rands for every £1, right? The difference between those two prices is what we refer to as that company's commission, right? So that's their commission. Now, so if you now want to convert your pounds, if you have been touring overseas and you want to convert your pounds back to rands, they're only going to give you 16 rands, 61.1 rands for each pound. Okay. So simply that difference is the commission of the business. Now you are very fortunate in financial accounting too. We are going to ignore the commission. We're just going to give you one spot rate, whether you buy or sell the currency, because we are basically just going to buy currencies because we are importers, right? We're not. If we had been exporters, we'd also be selling some of our currencies. But an importer, because we have to pay our foreign supplier, means we'll have to go and buy the foreign currency, right? So we only need to focus on the one. But just to understand how foreign exchange works, ladies and gents, let me just go back to the chat facility. Just to understand how this works. So let's say, for instance, you have to make a payment of £10,000. If you've got your calculators ready, please. You've got to make a payment of £10,000 to a supplier in the UK, in the United Kingdom. How much is that going to cost you? Before I work it out, let's see if you can give me an answer. I'll work it out as well. It'll help if I switch it on first. Okay. Let me start again. There we go. You guys are extremely clever. Maybe we should just let them pass this topic already, Mr. Borman and Mrs. Moore. Thank you, Kosar and Tukozu, Ibonga, and Elisiwe. Yep, you're all correct. So how did you arrive at that? That 192,338 rands, you simply took the $10,000. Yes, please. You'll enjoy writing the tests. A1. So you simply took the amount that you owe in the foreign currency, which is £10,000. Then you go and have a look at what is the spot exchange rate. In other words, the exchange rate that is prevailing at that point in time when you are actually doing your translation of the currencies. And we see, according to that ticker board, it is 19 rand 23.36 cents to the pound. So that means if we multiply the £10,000 that we need to pay with that exchange rate of 192, sorry, 19.2338 rands, then we find that the amount, in order, this is important to understand, in order for £10,000 to land, to end up in the bank account in Britain of our foreign supply, for us, what must we pay for £10,000 to end up in their bank account? How much will be leaving our bank account in South Africa in terms of rands? This is it, right? This is it, the 192,338, right? So at that point in time, where the exchange rate is 19.2338, in order to ensure that £10,000 end up in the supplier's foreign bank account, it means 192,338 rands will leave our rand-denominated bank account. This isn't part of our course, but just for interest's sake, just to see how much profit these guys make. Let's say, for instance, you've got £10,000, right? You've got £10,000. You now return from Britain. You want to convert that back to rands. How much rands will this same bureau de change give you? You can type it for me while I work it out. Fortunately, this time my calculator is on. There, you've all got it perfect. I didn't actually need a calculator for this. If you just add 5 zeros to it, right? Okay, so you're 100% correct, ladies and gents. Setu, Audrey, Akona, Zazipo, Nelisiwe, Glody, all of you. 166,110. That's what you'll get. So you'll see the difference between those two figures are basically the commission that they charge you. Okay, ladies and gents. Now, let's go back to the transaction date. How do we determine the transaction dates? Let me just stop. Let me just go back to my Word document, my so-called whiteboard. Um, okay, so now we've got to go and determine the transaction date. Now, ladies and gentlemen, there are a number of methods that has been well documented in international trade. Uh, the four methods that are normally used we are going to deal with. So let's start them from the earliest date of transfer of responsibilities or risks and rewards to the latest date. The first one is called the free on board system. Free on board system. Now, make two. Also very often just referred to as the FOB system. Now, what makes these things easy for us is if we understand from whose perspective these terms have been created. So the first thing that we must understand when we talk about how do we determine the transaction date, in other words, when do we as customers or importers assume the risks and responsibility for the goods, is that all these terms have been created from the perspective of the supplier, right? The exporter or the supplier. So it is not from our perspective, who are the customers or importers. This is from the perspective of the supplier. So this first system, and remember, this is purely a matter of negotiations, right? We as a customer and importer, we've got to negotiate with our supplier or the exporter in that foreign country which of these systems we are going to use. You can even use a mixture of the systems. Some kind of inventory might be more risky than another kind of inventory to transport, and then the supplier might be a much bigger company than the customer, and the supplier might be, from an economic point of view, be much stronger to carry the insurance and the freight charges. But obviously, they will have to be compensated to some sort of degree by the customer. But anyway, so the first one that we are going to discuss is free on board. So this is from the perspective of the supplier, right? So what that means, as soon as the goods have been loaded on board a vessel, and that vessel can be a ship, that vessel can be an aircraft, that vessel can even be a train, right? We've got the Eurotunnel. What's that? I forget the name now, but anyway, that train that actually runs between Britain and the continent of Europe, for instance, right? Or we might transport things by train from South Africa to Zimbabwe or to Namibia or to Kenya or to Uganda and so forth, right? So it's even possible by train. But anyway, to cut a long story short, as soon as the goods have been loaded on board the vessel that is going to transport it to us, the supplier is free from any further responsibilities, right? Now it's the responsibility of us as customers and importers. So we must arrange for a shipping agent. We must pay the freight charges, which is basically what the shipping agent is going to charge us, right? We must make sure that the goods have been insured. So if something goes wrong, heaven forbid, then at least we can claim insurance. It's not a total financial loss for us, right? So it is our baby. So if we have negotiated the free on board system, as soon as the goods have been loaded on board that big ship that we've seen the picture of a little while ago, no longer the responsibility of the supplier, it's the baby or the responsibility of the customer. The second method that is very popular is carriage insurance rate, very often referred to as the C.I.F method. Again, to make it easy for ourselves, we must understand that this is from the perspective of the who? The supplier, right? It's from the perspective of the supplier. So that means, ladies and gentlemen, if we have negotiated as the importers or customers, if we have negotiated the carriage insurance freight method, it means, because this is from the perspective of the supplier remains responsible for the carriage insurance and freight, which means they must arrange for the shipping agent that's going to transport the goods to South Africa, say for instance. They must pay the freight charges, right? They must arrange for insurance on the goods that for the duration of that voyage, right? Which means in turn, ladies and gentlemen, and this is important to understand, that means as long as the goods are at sea, even though it's not under control, physical control of the supplier, it's still the responsibility of the supplier, right? In the free on board system, we haven't actually have got physical control over the goods yet, but it has already become our responsibility. So to cut a long story short, if you are using the free on board method, the transaction date will be deemed the date on which the goods have been loaded on that vessel that's going to transport it. That's the transaction date. Okay, right. So that will be the date that we deem the transaction date to be. In the case of the carriage insurance freight method, we are going to deem the transaction date to be the date when the goods reaches its port of destination. So if you are importing something from Southampton in England, then the supplier will remain, if you are using the CIF or carriage insurance freight method, remain responsible for the goods until it reaches Cape Town, right? And only on the date when the goods, that ship or aircraft, lands in Cape Town or docks in the port or arrives at the harbor, doesn't need to dock, but at least arrives in the safety of the harbor, then we deem that the transaction date to be. So only then are we going to record the purchase of the inventory. That's the point. Okay, that is the whole point. So we're only going to record the inventory purchase on that date. Another popular method that is used is delivered at terminal. Delivered at terminal, and they often refer to that as D.A.T, the DAT method. Now, ladies and gents, just as a matter of interest, I don't know if any of you, maybe I can just go and have a look at the chat facility quickly. Have any of you ever ordered anything from Amazon in the United States? Have you ordered anything from Amazon ever? Just yes or no? Even if it's a no, if you haven't, I just want to see if you have, Samara. Thank you. Most of you haven't. But anyway, when you do that, you're in for a little bit of a surprise because not yet. I wouldn't recommend it. I wouldn't recommend you ordering. We've got better goods in South Africa than you order there, and it actually becomes very expensive. But anyway, the Amazon, they use the delivered at terminal method. That is basically the point that I wanted to make. They use the DIT method as their default. So what happens, ladies and gentlemen, when the goods are loaded off from the ship, right? When the goods are now physically by those cranes, they pull it off, they lift it off the ship and they put it on shore. That is when we refer to it as being delivered at terminal. Mr. Borman also found a nice little term that I haven't actually encountered before, but it seems to be a modern term when it crosses the. Now I forget the term actually. But anyway, when it crosses the rails of the ship, right? So now it's not on the ship anymore. It is now, as we refer to it, as on shore, right? That means it has been delivered at terminal, right? So if we have negotiated that deal with our supplier, it means the supplier remains responsible for the goods throughout the voyage while the ship is waiting outside the harbor until it is docked and until the day that it is actually loaded off from the ship. And only then do we as customers assume the responsibility for the goods, and that will then be the date that we deem the purchase transaction to have taken place. Right. But ladies and gentlemen, there's a fourth popular method. Now at this stage, as you know, those goods are going to wait a little while. It's going to rest a little while in whose warehouse? The customs warehouse, right? The customs warehouse. And as we've said a little bit earlier, they're going to check whether there's not any illegal contraband being imported. They're going to do it on a sample basis. And if it's something like computers or motor vehicles, something that bears import duties, they're going to slap a tax on it, right? Which we call import duties. And only once we have paid the import duties, or one of the parties at least, we'll see which party just now. Once one of those two parties have paid the import duties, only then would the customs officials release the goods, right? Then now you can take it as a customer, now you can take it to your premises. So they're delivered at Terminal 1. Why I mentioned that Amazon uses it. I've ordered a few things over the years from them. And sometimes I forget, you get your little slip from the post office, your goods are ready to, you can come and collect them. And when you get there, they say, by the way, you still got to pay 1,000 rands worth of import duties. Okay, so Amazon doesn't pay that on your behalf. They make sure that it gets delivered to your country, but then it's your baby. You have to pay the import duties. Then the last one, the last of the four most popular methods is what we call delivered duty paid. We often referred to as DDP. Right, delivered duty paid. Oops, I missed it. Up there. There we go. Delivered duty paid. So, ladies and gents, that means, again, from the perspective of the supplier remains responsible for the goods until the customer, which is now us, can actually get the goods. We can collect the goods from the warehouse, from the customs warehouse, and we can transport it to our premises. So, ladies and gentlemen, in this last case, it means the supplier upfront is going to find out what will the import duties be. They will pay it. So you as a customer, all you need to do, if you have negotiated the delivered duty paid method, you will wait for the notifications from the customs warehouse that the goods are now ready for you to come and collect, and then you can arrange for transport. You can either go and fetch it yourself, or like we saw in that earlier photograph, you can arrange for a transport company to go and pick it up at the customs warehouse and transport it to your premises. Ladies and gents, that is all from my side. Don't change your channel yet. The TV show is still going on. Mrs. Moore is going to take over after me, so don't flip channels. Don't do channel surfing on us. I just want to find out whether there are any questions on this. This is really the introduction to foreign exchange as a concept. When it comes to importing goods, we haven't looked at specific transactions yet. Mrs. Moore is going to start doing that just now. So just before we take a little break, Mrs. Moore, I guess we can take maybe a 3-minute break, just a comfort break for students to maybe go and grab a glass of water, or the opposite thereof. let me just check whether there are any questions, and then we'll take a 2 or 3 minute break. Any
That's
questions,
fine with me,
Mary?
Mr. van Rensburg.
Perfect. You can either type it there in the chat facility, or you can ask it in person. We always welcome, you know, in these times, it's wonderful to hear somebody else's voice as well. Doesn't seem to be any questions. Okay, then let's